Welcome back to Commercial Real Estate Secrets. I'm your host, Austin Hare. Our guest today is Randy Blankstein, and he's the founder and president of the Boulder Group, located in Chicago, which was founded in 1997, and he's been in real estate for 31 years. He's also an active content contributor on blogs and social media. So, Randy, pleasure to have you on the show.
Thanks for having me, Austin. Big fan.
Oh, great. My pleasure. Well, very cool. So, I know that you're located in Chicago now. You're in commercial real estate, but we want to get to know Randy. Who is he? Like, what was it like growing up? How did you get on this path?
Look, fairly normal upbringing. I'm from suburban Chicago in a small suburb. I actually live in the same one today, so I haven't go very far in life. I didn't, like every other kid, was interested in, not like every other kid, like myself, I was interested in, finance, real estate, financial markets, things of that nature. So
At a young age?
At a fairly young age, I
That's
always
cool.
was interested in kind of business books and biographies and, just something that was more interesting to me than other things.
How old were you when you first picked up a business book?
Probably in fifth grade.
Wow. You beat me.
I just thought it was interesting, not that I was any great future things to come, but it was, they're kind of interesting reading. To this day, I still read a lot of business biographies. I just read the one on WeWork, actually, which is kind of interesting. But so, I just developed my own passion in business. My dad was, bought and sold small companies, so I was kind of familiar with the business environment.
Cool.
Had a business background, and was exposed to a lot of things in my childhood, and a lot of other people's parents were business minded in my community or ran small businesses. So, it's just something of interest and something I had firsthand experience with.
Did he put you to work at the companies that he was buying?
He did,
Nice.
I was at the, usually you start low when you're associated with someone who owns a company. I started at one lot lower than that. Because I'm not sure if he didn't trust me to do anything important or, he was teaching me the absolute bottom of the barrel. But either way, like everybody, whoever does it, it's good work. It's good that you see every position. And, even to this day, I'm not above sweeping floors or cleaning up because that's, someone has to do it, has to be done. And, you can't really think anything's beneath you or under you when you are a jack of all trades. Selling small business today. So you have to kind of, wear a lot of hats.
Yeah. I feel you on the wear a lot of hats part. Well, cool. So what was that kind of like, did you do any side hustles in middle school, high school, like for money? Did he mostly keep you working at his businesses, and what was that like?
Mostly his businesses, and then did the usual stuff around the neighborhood. I do some snow plowing, some landscaping, kind of just odds and ends and random businesses. If it were today, I'm sure I would have been on eBay or doing some other things to monetize.
Or dancing on TikTok.
Whatever it was to do a side hustle. Again, much tougher back in the day and a little older than you are. Things were more local and more, smaller minded, I guess. But no, I have a son who does the same. He buys and sells sneakers and other things. So
cool. Is that going well for him?
At times, sometimes he makes a lot on some stuff. I've seen a lot of stuff, he does for pretty much nothing for a lot of work. So, the market gets hot and not, but it's a good learning curve. And that's what I'm interested in him doing it, understands, basic supply and demand and basic business fundamentals. So I think it's great at a young age to try something and get involved. Even if it's unsuccessful, the lesson's worth far more than the money will be at that time.
Yeah. At that stage in your life, 100%. So, all right, when did you decide that you wanted to get into real estate? Like, did that influence where you wanted to go to school for college?
No, I was at the business school at University of Colorado, and I was a finance major, not a real estate major, because I thought finance was broad, and I'm still thinking of going into kind of, financial markets and things of that nature versus real estate. Couldn't really decide at the time, but figured, finance had more leeway to go into both versus real estate, which is more pigeonholed. Easier to go from finance to real estate than from real estate to finance.
True.
So, when I graduated, I had some friends and family friends who were in the real estate business and, did the rounds and did some internships while I was still in college and, decided that for no other reason that, people were the most like me at some of these real estate firms as far as interest, ambitions, and kind of the entrepreneurial nature of it really attracted me to, because I'm always I'm not really I would be a bad corporate employee or a bad Fortune 500 company because of the rules and regulations. I'm more, I guess, independent minded. So real
Yeah.
estate kind of fit my personality a little bit better.
With
And
the time freedom, you mean, and the location freedom?
with the time freedom, with performance based, compensation,
Yeah.
and just interest level. Meaning, I don't feel like I'm working half the time because I would do some of this research and curiosity anyway. So, a lot of it is just something that's you find interesting. Um, so look, I decided, after meeting with a bunch of people and looking at different positions, worked for a large company called Equity Office Properties in Chicago, which is run by Sam Zell, and was an analyst at the time. Kind of learned the markets, and then haven't really looked back. I think commercial real estate's great, and excited today as I was when I got in 30 years ago.
Yeah. It's interesting that you said, paid for performance, which that's the thing that I like a lot too. So many people they want security, right? They if they give up any bit of their time, they feel a sense of obligation for compensation. And it really takes away from the bigger picture, right? It really takes away from long-term benefits. And that's what we're seeing. I think a lot around us is people, they want to get paid upfront and immediately, before they necessarily put in the value. But there's just limited upside, right? I mean, there's a reason that CEOs make 1,000 times more than some of the employees are, whatever the statistic is, like 150 times, 900 times. But it's because there was delayed gratification, right? Like they took a risk in not only their time without compensation, but they put up their money without compensation. And when you're an employee, you're guaranteed to get those things, right? And there's not necessarily anything wrong with that, but it's just you're not going to get there's different rewards for different choices, right? And so when you're guaranteed income and when you are guaranteed to make money for your time, you're just not going to make the same returns as if you are a pay for performance, right? Or you get paid for performance. And it sounds like that was the kind of environment that you were in when you first got started out too.
Yeah, I mean, look, I've never had any kind of fixed compensation since day one. So I never felt I was giving up anything to get into it. I've only known variable compensation, and a lot of years my income swings 30 to 50%, and I've never known anything different. So it's more normalized to me. But I certainly employ, and some people work here who are millennials who are more fixed income based, and some of them have transitioned to more compensation based on performance. And it's been tough for some of them because they feel like it's a step backward at times, and it may be in the short term. But again, you have to bet on yourself. And I'm a believer in, not arrogant, but on a confident basis that I'm a big fan of the Nick Saban quote, which is high performers don't like mediocre people. Mediocre people don't like high performers. So
Yeah.
if you think you're a high performer and you think you have a hard work ethic, go bet on yourself and prove it.
Yeah. Yeah, and I mean, there's a place for people who want the sure thing, who want security. You know what I mean? There's a place for people who want 9 to 5s, steady income, not much risk, not much upside, and that's totally fine, right? There are a lot of companies hiring that personality type, but it's not really a place for people in real estate, I don't think.
Yeah, look, it's a lifestyle choice. And if people who want to, work at a more refined schedule and are happy with that lot and don't want to have compensation that swings all over the place, look, I get it. I don't criticize it. It's a different personality type. It isn't me. So I believe, like, I think I'm a hard worker, and, I think I can succeed, and I've proven my success. And, if you do that, you're happy to bet on yourself because you realize there'll be a lot larger compensation for you in real estate, especially
Mhm.
commercial real estate is um, a game where there's a big upside. You just have to be willing to, do the right things, and it takes a long time and build a reputation. And I'm confident that the majority of people, not everybody, but the majority of people can earn more money in commercial real estate than they could versus fixed income. But there's a time curve required and a learning curve, and unrelenting world out there that won't let you kind of slack off. So it's for some people, but not others.
Yeah, yeah, I agree. Nobody ever really changed the world working 9 to 5, right? But
Very
and
difficult.
I hate that. I don't want it to sound like I'm hating on them. I'm not. Like, it's just that they're different people, and certain personality types should do certain things. It's just different. But yeah, okay. So you were working with this firm, and that's kind of where you got sharpened your teeth. It sounds like. How long were you with them before you went out and started the Boulder Group?
I was with them a year and a half again as an analyst for a major company, which is now a public REIT.
Nice.
Following that, I went to a kind of a mid-sized firm, which has been acquired 2 times since,
Okay.
and is now a company called Cushman & Wakefield after 2 acquisitions.
Oh, they're are they big in Canada too?
They're big in Canada, but they're one of the top 3 commercial real estate firms in the U.S. I don't know
Yeah.
what the market
Yeah.
share
Yeah.
is.
Okay.
A big company now. So I did that for a few years. I ran AT&T, their industrial portfolio in the Midwest. So all the service vehicles that fix your cable and your phone lines and everything else, go to garages at the end of the day and, outsource, manage that third-party portfolio. And as part of doing that, realize that, these properties, which were, AT&T was investment grade at the time and is today, but different company at the time. It was Ameritech, which was a regional version of AT&T. Anyway, they a lot of people wanted to buy these properties, and when you built them, there was a fixed buyer pool that could go into, and I kind of realized there was this huge market here and thought I could take advantage of the opportunity. So, 27, when you really don't know much, but you might think you do, I was naive enough to go on my own and start the Boulder Group with these contacts and kind of parlay it into this little niche, which was called net lease, which just means single tenant properties where they're more passive because the tenants do the majority of the work, not the landlord. And one thing led to another, and one deal led to another relationship, and here we are 24 years later at the company and still doing successful. We ended up on top 10 firms in the country last year, despite a fairly small, unique boutique firm.
Wow. Wow. Congratulations.
Thanks, appreciate it.
So what was the biggest challenge going from working with a firm, working with a group of people, to going out on your own?
It was probably unique to me, which is crazy enough, this is a field that is controlled almost exclusively by extroverts, and I'm an introvert. So kind of having to, be in every position, having to force myself to be much more outgoing than I am as a person. Not kind of ingrained it as part of the cost of doing business, but it's not a natural thing for me. That was very difficult at the beginning. And, I think it's been, you come up with a set of ideas like, hey, if I had my own firm, I could do this better, or I could do this better. It was a time to prove it. And that's what was exciting about it for me. Yes, it was not an easy path, but, we kept going the right direction. And, we really, outside of 2008, not had a down year. 2008 was the financial crisis, which did not go well.
Everyone in real estate had a down year that year.
Yes, because the financial crisis was a disaster. But like even last year, which COVID certainly was not a very good year for most people. We really only had a bad second quarter, and then it started to climb from there. And by the fourth quarter, volume was pretty good again. So it was a terrible second quarter, but overall last year actually wasn't nearly as bad as anyone had thought, and it was actually an okay year for us.
Yeah, so pretty much there was pent up demand that wasn't able to get exercised during Q2 just because nobody could go anywhere or do anything. And so did you see those deals that got stalled in Q2? Did you see them come out in Q3 and Q4? Or was it a lot of stuff got scratched and then new buyers came in?
It kind of reemerged. So, look, in Q1 last year, if people forget, January, February, right before COVID hit, in March, were really very strong months. It was looking to be a blockbuster year. And then it screeched to a halt. And, the deals changed. So, when it's a boom times, people are buying secondary markets, secondary tenants, and they're out there on the risk curve trying to, get the highest yield they can in a boom market. Then, when COVID hit, people switched their criteria and said, look, I'm not care about the extra yield. I'm care about someone who's open, someone who's paying rent, and someone who has a long-term sustainable business model. People were worried about movie theaters, people were worried about gyms, people were worried about, second-tier casual dining. A lot of people who all of a sudden had concerns about those business models. So they moved to, drugstores, health-related users, QSRs with drive-throughs, and things that, were either essential or open or, strong performers during COVID. I mean, QSRs had a great year last year. People with drive-throughs.
Can you explain? Okay, so when you say QSRs, then you're talking about people with drive-throughs.
So QSRs are quick service restaurants, fast food for some. People like Chick-fil-A, their business was very good last year. Same thing with McDonald's and others. I mean, people were not going obviously to casual dining restaurants or to higher end restaurants and sitting down and having 2 or 3 hour meals. People were driving through as they felt more comfortable staying home, and it was kind of an outing. Going to the drive-through became a sad outing for people, and it was still food that was available, and it was these tenants were open, and at a time when people weren't allowed or not comfortable sitting inside. So
Yeah, it was amazing. It was impressive, the restaurants that quickly pivoted and started doing takeout, and they were crushing it because they just had so much less overhead. And then it was crazy, the restaurants that never pivoted and just tried to weather the storm, because some people never switched to a takeout method. And that part blew my mind just as much.
yeah, clearly people who did DoorDash and drive-throughs obviously fared much better than people that were trying to wait out the storm.
Yeah, yeah. So in general, you kind of see, in terms of economic booms and busts, you pretty much see the stock market correct the first. That goes down very quickly. Second, you'll see the residential market, real estate market. And then the last thing to really get hit of those three categories is commercial real estate. I mean, that's what we saw back in 2008, right? Like, it just took a while for all the dust to settle. And I think it was years later. I mean, I think it was 2011 or 12. I don't remember exactly when it was really the bottom of the commercial real estate market. Now that the dust is kind of settled, what do you think is going to happen? Like, how do you think that COVID has essentially affected the market?
Well, look, I think the thing that took the biggest hit was urban office space. Clearly, people aren't dying to be downtown, both from a employer perspective and from an investor perspective of buying, urban office. I think everyone's attitude is, look, let's wait and see. Let's see what percent remains remote. Who's going to move to satellite offices where you come in, 3 times a week, but maybe it's in the suburbs and maybe you're remote 2 days a week. So I think that's going to evolve, and it probably accelerated a trend that was already in place. And, for right now, no one's really wants to figure out, if these firms like WeWork are viable again. So I think, urban office, I think has a world of change ahead of it. I don't think a lot of investors are out there speculating as to how it's going to end. It's uncertain, but I think, just let's stay away and kind of see how it evolves. Certain sectors did great during the pandemic. I mean, industrial has been on a tear. Everyone obviously thinks that, e-commerce is not done gaining market share, and thus, industrial and last mile will remain hot. And retail, at least my retail, which is net lease single tenant, is in for a great few-year run. People look at retail and they look at it negatively because, they hear about these store closings or troubles with some of the retailers. And what really happened during COVID is it just accelerated the demise of people that probably would have demised anyway in the next 3 to 5 years. And, retail isn't a broad brush as retail, but the reality is, enclosed malls are having issues, and secondary, retail strip centers are having some issues. But, net lease is single tenant. A lot of people are coming out of the malls and want their own location and want a freestanding location. And some of them want drive-throughs for pickups. So you see everyone from the Gap to Sephora to Bed Bath to Lululemon to Apple moving out of these enclosed malls into their own freestanding locations. So that's good for me. And again, I think it's, going to continue for years, because I think the appeal of going to a mall is obviously declining by the day. And people want, quicker in and out of stores and more convenience and a place to stop on the way home, not a destination shopping day like they used to.
Yeah, that's interesting. And so when you say drive-through, are you talking about drive-through for non-food related companies as well, like some sort of
Yeah, I
mobile
mean, look,
order?
yeah, some people are ordering and picking things up, curbside. Um,
Wow.
they do internet ordering, they pick them up curbside. I mean, look, every retailer wants to figure out how to maximize omni-channel, and they
Yeah.
haven't figured it up yet. And so, even some retailers are doing drive-through returns, where you drive to the window, you give them the box, and you go on. Returns is the least
That's
talked about stepchild of retail, where you order a bunch of things and you return it, and then you have to go someplace to return it occasionally. That you may not have any time savings by doing that. And the whole purpose of the internet was supposed to be time saving. So, look, it always ends up kind of in the middle, which is, there's always going to be e-commerce is always going to have a place, and still probably growing from here. Physical footprint is always going to have a place as well. It may be changed, maybe smaller, and there may be less of them, but it's a combined experience. Some people love the shopping experience. Other people, would prefer to buy everything online. So, we'll meet somewhere in the middle. And I think, retail had troubles before it even started, which is the U.S. has more than double per square foot of space per person as any other country in the world. So it was bound to go down anyway, even before e-commerce took market share, and even before COVID showed up.
Do you think that we are artificially propped up right now because of stimulus money and unemployment money, or essentially reserve cash? And do you think there's going to be any corrections in the next couple years, like aside from COVID, but more something not quite as bad as 2008, but something significant nonetheless?
Well, look, I think our biggest problem is there's inflation, which is probably ahead. And again, I'm not going to predict the time frame because I've never been right about it, nor have most people I know. But clearly, there's a better chance of things. I viewed everything in probabilities. There's a better chance of inflation being greater moving forward than in the past for the last 5 years. Additionally, when you go borrow and spend like we're doing to pay for the stimulus checks and to pay for deficit financing, eventually people who lend us money are going to want a higher rate of return on that. So I think that these low interest rate environments, again, have to go higher. But again, they don't have to go higher in 6 months. They may have to go higher in 6 years, but there's a time between that. And everyone's playing this game of speculation. Well, when's the date? And, oh, I'll get in right before it goes up. Very difficult in reality. But, I can be certain that the more money you borrow, no one gives it to you more cheaply over time.
Right. Right. I agree. It's a good time to borrow money if you've got a decent plan for it. And yeah, it's funny because I hear a lot of people talking about like, oh, we're in for another correction. Oh yeah, we're going to have an economic down cycle. Oh, this can't last. This is fake. But I mean, at the end of the day, there's really only a handful of sectors that were really affected by the pandemic and the lockdowns, right? Like if you were in entertainment, if you were in hospitality, if you were in travel, if you were in fitness, like, you were severely affected. But aside from like those 4 or 5 industries, most people were either unaffected or had great years. I mean, a lot of people in the e-commerce space just had stellar years, right? Just had much better results than anticipated. And so the question is, is that industry, are those several handful of industries enough to drag down the entire economy? And I don't think that we have enough evidence to say that it will. I mean, obviously, yeah, we do have inflation, right? And we do have that sort of things. And whether that's good or bad, it doesn't really matter what we think because it's going to happen, right? And so it's like, unless we really have hyperinflation, I don't think it's going to be enough to drag down the entire economy. I do agree with you that, yeah, we're going to see a lot of inflation over the next 6 years just because we created 35% more dollars than were in existence in the last 12 months.
Yeah, there's no question about it. You can't spend unlimitedly without paying the price eventually. I view it to my kids who, I was a little less sophisticated, as it's like a credit card bill. You can go spend whatever you want during the month, but there's a point where it becomes due, and and then paying it back is the challenge. You kind of spending today and selling out your future, less spending in the future because more of it you have to pay back. So, again, I don't time things because it's just too hard. But certainly, if I was betting, and I am, at least my stock portfolio, I'm betting for a 5-year inflation to be much greater than it is today.
Yeah, I agree. I am with you on that. I've been investing a lot in the market as well, and I think that we're gonna have. I mean, it might, it'll be volatile. There's no doubt about that. I think it's gonna be increasingly more volatile, but I think overall it's gonna be up and to the right for, yeah, like you said, 5 years, maybe even 10 years, right? Like we'll have better data as we get closer to that time frame. But yeah, I think we're in recovery mode, and so the other thing is, inflation drives up the price of assets, right? The ironic part about it is that it actually hurts wage earners the most. When you print money and you have stimulus packages, people who own assets benefit on paper, and people who are wage earners largely just get stuck with their dollar going less far. But that being said, what can you do to protect you and your family? I mean, you can buy assets, right? So you figure out a way to own assets. And so even though like right now it's crazy with the real estate prices in commercial and residential. I mean, they've gone up so high and they've gone up so fast. You would think that we're in a bubble, but the problem is that this is where we already see the first part of inflation. You know what I mean? Like there is a lack of supply, like you talked about earlier, and there's only been increasing demand because now people just want more space for everything. And we've been in a deficit in terms of new production, in terms of supply, in terms of developers making new places, new houses, new apartments, new buildings. All that kind of stuff has been like historically slightly slower, and now it's a bidding war, right? There's tons of cash on the sidelines, and so even though you have to pay a premium right now, even though it's expensive right now compared to what it has been, I still think it's a good deal because the inflation is only going to make the value of these assets go up. So I don't think that you're overpaying right now. What do you think?
Well, it depends. I mean, look, I think for things like apartments where you can grow rents on a yearly basis, or hotels where you can quickly adjust to the inflation, um, yes, you can make that argument. For things that have long-term duration, and my sector net lease has longer term leases, from 5 to 20 years. If you have a fixed, income stream over time and inflation kicks up, the value goes down. So, for the shorter term lease of things, and again, hotels, self-storage, apartments, yes, I agree with you. It's a good time to buy and get in if you believe in inflation, because you can change the rents and reflect it. For things which have longer term leases, you can't take advantage of those, and actually your your lease value goes down over time. So it depends on what sector you're in. So I mean, under your theory, you want to buy all short term leases or vacant buildings or things which change frequently, rental rates.
Yeah. So how do you adjust for that then, knowing that, we're in an inflationary economy, and the lease rates, and typically, because I know you work with a lot of Fortune 500 companies, they are on the longer side. What are you guys doing, to account for that sort of thing?
Well, look, this part of your portfolio, which is, passive, if you want a Walgreens, let's just say, for example, a 20-year lease, it's like your bond portfolio, meaning it's not supposed to be, scaling these huge gains. It's supposed to protect you in down times and provide you with a fixed income. So it's your fixed income part of your portfolio. Again, if you're looking for speculation or higher returns, you have this, and then you as your bond side of your portfolio, and then you have your stock or your things which are adjusting to inflation and more speculative. So again, I think it's a part of a portfolio, your conservative part, your hands-off management of it. So I think it's again part of your portfolio. But yeah, it'll suffer some things if inflation is great. But again, I think a lot of people have predicted inflation over the last 5 to 10 years and haven't been right yet. So, we can be wrong and probabilities can
Yeah.
change. And things can stay a little bit elevated or bubble like for longer than you expect, even if they eventually correct. So, without trying to time it or have a perfect view into the future, we think it's just a part of a portfolio, this kind of real estate, which offers returns, which are greater than bond yields. So that's the attractiveness of it. I mean, at the end of the day, you have a demographic that's aging and undersaved for retirement and needs to find higher yields. And if 10-year treasury is yielding 1.7, and a cap rate for life properties is 5, you can invest in one of these properties and triple your current income if you're a bond portfolio investor. So it kind of depends on your life cycle.
Well,
and
even
what
more
other
than
assets
that,
you own.
if you use leverage, you could more than triple it.
Yes, but I'm saying on an all cash basis. But yes,
Yeah.
leverage you can do even more. So again, as long as we have a large segment of the population looking for yield, which is what everyone is starved for at the moment, anything that has yield has great value. I won't want to put all your portfolio in anything, but certainly a portion of it. The argument's kind of easy, especially if you're a bond investor historically.
Yeah, it's an interesting thought. The properties that you deal with, they're kind of there's a dichotomy there between inflation. Like at one point, by one token, it drives the value of the asset up, but by another token, the lease, will drive the value of the asset down. So are you seeing? Go ahead.
Yeah, I mean, but look, it also drives the residual value of it up because construction costs go up and rents go up. So if the tenant never leaves or there's a non-renewal event, your residual valuation of the asset's great, even if your lease could be a hindrance at time because it's under market rent at that time.
Mm-hmm. Have you seen anything happening in the leases to account for this sort of thing, like in terms of like maybe extra increases in rent when the terms come to an end?
Look, it's in a market with a shorter supply, tenants are trying to push a lot of clauses which they couldn't get away with and people wouldn't buy previously. So they want to do shorter term leases. They want to have adjustments they want to try to put in COVID clauses or similar pandemic clauses. If this happens again, they can get discounted rent in exchange for automatic extensions or what have you. So they're trying to prepare for it and they're able to push it because of the market being on their side. So it's kind of supply and demand at a time like this. Tenants are largely in charge because there's very few that are expanding and they're trying to push, the best leases they can get. But it's the opposite from investors. What's good for tenants isn't good for the landlords and investors.
Right. Yeah. It's a constant balancing act. That's for sure. So in general, like what have you seen happening with cap rates since, February, March of last year? Like, do you feel like they've been going up or they've been generally going down? And just to everybody listening, cap rates are a little bit complicated. We have a podcast talking about that early on, what they mean and how to evaluate them. But essentially, the lower the cap rate, the higher the cost of the building. It's based on the rent. So, Randy, have you seen lower or higher cap rates in the last year?
Lower. We're at for office and for industrial and retail. Um, we're at historic lows today. Combination of interest rates and not enough product. For office, they've gone up slightly. And the Q2 of last year, they still went down, but they went down on 70% less volume in that quarter. So they may have gone down, but only like the premium stuff traded. Everyone else just kind of played wait and see and canceled a lot of deals and stuff. So they're still going down again until people are convinced interest rates are going higher. And again, with limited supply and a lot of people looking for fixed income, it's there's just a scarcity of product, so people are bidding them up. That's kind of where we are, and it still hasn't changed yet.
Would you have predicted this 1 year ago?
No, I mean, I think most people thought COVID would be far worse than it was, and it certainly wasn't good. But I think people were put it themselves in disaster mode of
A
historic,
little bit of catastrophizing.
yeah, historic plague and other things. So, anything less than worst case scenario ended up being better. And I think that's kind of where we are. I think people understand that, with vaccination, people feel real good about Q3 and 4 of this year. And I think there's, at least for this year, I think everything will do fairly well because I think there's a pent-up demand for and everything from live events to travel to fine dining, just pent up. So I think everything's gonna, be the beneficiary from, you know, that. But the question is what happens after that dust settles? Everyone gets out and does everything that they wanted to do for the last year and a half. And then, what happens in 2022? I think that's the open question. I think cap rates stay, fairly similar to start going slightly up, but I don't think it's dramatic. I mean, everyone thinks there's always these dramatic things happening. Even me who thinks that inflation has to happen and won't be good 5 years from now. It doesn't have to go up tomorrow morning. It can wait 2 or 4, then pop all at once. It doesn't have to steadily go up for 5 years in a row. I've been, unfortunately, being older, you see kind of things like I saw the dot-com bubble of 2000, and things can sustain longer than you expect them to, even if they eventually go to where you expect them to. They don't have to go there right away.
Yeah. No, I get that. But I mean, I would argue that we already are seeing inflation, and that's in terms of cost of assets, right? Inflation has already set a course. Maybe won't be drastic, but like just the cap rate compression to me is a sign of inflation. The fact that housing prices have gone up 10% in the last year is a sign of inflation. The market rallying to all-time highs, buying companies that are now trading at a 25 multiple of projected earnings is a sign of inflation. So I would say like inflation has already been priced into the assets, which means, if you have assets, like you're actually already you're benefiting from it. You know what I mean?
There's a lot of inflationary signals already out there, from the price of lumber to cap rates to the multiples. Yes, there's a lot of the signs. The question is, has most of that moved behind us or ahead of us? That's where the debate still is.
Yeah, that's a good point. I mean, I can kind of see the price, the real estate, at least residential, kind of. I don't see it coming back down. I can see it flattening off. And then other forms of inflation, other areas of the economy and the market sort of catching up to that at some point. But I think that there's just no supply. People want more space, and the demand is outweighing the supply, and that is forever going to create a seller's market, right? As long as that happens, the people who own the houses. So, yeah, that's interesting. So, you are primarily focused in retail with your triple net tenants, correct? Or do you have different buildings in various industries?
It's primarily focused on retail. I mean, industrial and office, the single tenant stuff tends to be a lot larger. Things like, Microsoft headquarters or an Amazon industrial building. These are $50 million plus properties. Whereas retail, everyone knows Dollar General is $1.5 million, and a lot of the tenants are in the $1 to $5 million range. So that's just where the majority of tenants are in this space.
And do you like bundle these into portfolios, or you're doing individual sales, or how does that work?
Most of them are one-off sales. A lot of them are, what happens is you have apartment owners who, get up there in age and they have a large gain to protect, and they, looking for passive income as they head to to Florida or whatever their retirement may be. They're looking to get out of their kind of local management intensive business and company, sell the assets and then not pay taxes through 1031 exchanges, and then buy these type of properties which are more passive and collect the income in their retirement. That's more of a typical scenario for us.
Okay. And that actually reminded me, there's some legislation in the works right now that I think that they're trying to pass about getting rid of the 1031 exchange. Have you been keeping up with any of that, or at least getting rid of it for gains over 500,000?
Yeah, very much so. It's kind of the hot topic, what's going on. It was in Biden's speech last night. A lot of articles written about it today, and people involved. Look, I think there's going to be some impact on 1031 exchanges, some limitations. I don't think they're going to be exactly what was announced last night. I think there's going to be a lot of pushback and look for changes. Maybe instead of 500,000, they limit it to you can do one a year or whatever the concept may be. So they're looking to curtail it in, and I think they'll get some changes around the edges. I don't think it's draconian as far as the actual 500,000 they proposed, or I don't think it's going to be eliminated. But there probably will be some adjustments around the edges to it as well.
Okay. So you don't see that affecting the market terribly one way or the other?
Not unless they actually get the full thing that they were looking for last night, which goes after carried interest and a whole variety of other tax breaks for high net worth individuals. Again, I think it's very easy to paint a broad brush and say, look, these people should be paying more in taxes and go after the people who are primarily in the 1%. But the reality is there's downstream ramifications from villages that get transfer taxes to attorneys who are involved in less people doing transactions, real estate attorneys, title companies, and then if the value of real estate goes down, who the main holders of real estate, which is banks, insurance companies, people's retirement, people's pension funds through REITs. So it's much more complicated than just going after the 1% and eliminating 1031 or any of these taxes. So I think they have to be either phased in or minorly modified. I think elimination of them is would be problematic from a variety of perspectives.
Mm-hmm. Yeah, I agree. I mean, it's so ingrained, it's so baked into society, to the market. I mean, the way that we price deals, everything. When you throw something like that into the equation, there's a lot of unintended consequences. There's a lot of unforeseen side effects, because I believe what I was reading is the 1031 exchange was created in 1921.
Yep.
And so that's literally 100 years, right? For 100 years, real estate pricing has been based on the fact that there is the ability to roll over your capital gains. And so it's like, it's to me, it's like playing chess or playing checkers when we're really living in 3D chess. It's like, oh, okay, well, we need more taxes. So are we need, you know what I mean? So let's cut this. Let's just slice this. Boom. But it's like, well, there's so many unintended consequences that you could actually have a net negative, and you more than likely would have a net negative if that all went through.
Yeah, look, things that are in laws for 100 years, most people think are probably never going to be changed. So obviously, changing it in a very quick fashion it would be significant if it got rammed through as is. So again, I think it gets scaled back, and I think there is a lot of pushback. So we'll see. But again, I think it's really not good as in the current state that they proposed it. I'm hoping that was just the first round wish list, and that it gets negotiated to something more sustainable.
Yeah, I guess it's one of those things, shoot for the moon and then at least you hit an eagle or whatever, however the saying goes.
I think everyone understands that if you want something, and you're a politician, you don't exactly for what you want, you ask for a little bit more so that the other side can feel they, negotiate a little bit and got it down, and each side can, claim a victory for their participants.
Yeah. That's cool. And kind of like the way we see things shaking out here at Leaders Real Estate. I mean, we focus primarily on healthcare, and within that, retail healthcare. But we see like the demand for good real estate will always be there, because you might change your locations, like some of these restaurants or maybe a gym or whatever might have gone under, but somebody's going to want to come get that spot. Whenever there's a good location, you're just going to have demand. And so what we see is like people who are in B locations will move up to A locations. People in C locations will move to B locations. And then kind of like the ones stuck holding the bag will really be the people in the D locations who just don't have great real estate to begin with. I mean, are you seeing similar things? Do you think that's
look, on top of just C going to B and B going to A, you also have now everyone who was an inline tenant that has a drive-through could benefit, QSR primarily. If you're Dunkin' Donuts and you're in a strip center, all of a sudden you're dying to have your own freestanding location with your own drive-through, both from the drive-through perspective and the visibility perspective. So you have those users, and then you have the previously talked about tenants coming out of enclosed malls who are looking for locations. So, I think it's going to be, tighter on who's looking for space, especially the A spaces. And certain things like drive-throughs, are difficult to get and grandfather in and fight municipalities. So, they become, very valuable. So
that's a good point. I can see it now. Drive-through dental, root canals in 15 minutes or less.
Let's hope it doesn't come to that. But
yeah, right.
There are things which, again, even if it's storage returns that you can drive through doing that, they're going to do just, because their competitors won't, and it's a slight advantage. So, and again, every fast food tenant used to have, single drive-through, and then all of a sudden, Chick-fil-A say double drive-through, and Chick-fil-A has done amazing. So there'll be a million copycats just to have the double drive-through model.
Do you think the drive-through model is something that was inevitable that's going to be sped up, or do you think it's a result of the pandemic and people wanting to social distance indefinitely?
Well, I think there's part of that of the social distancing and pandemic. I think the second half of it is looked as an expansion of delivery services like Uber and DoorDash, et cetera. And, they may have their own lane of third drive-through just for delivery services or carry out. I mean, that's a growing sector. And I think a lot of people have, expensive or not, have now gone addicted, at least if my family's any indication, of, ordering delivery services on, much more often than they used to.
Yeah, I can imagine. Okay. So yeah, I guess, in that sense, that's going to lead to an increasing demand for retail real estate, especially standalone units. I mean, standalone units take up so much more space than multi-unit, locations that have inline users and stuff like that. And so, yeah, in that sense, I mean, that shift alone is obviously going to increase the price, right? It's obviously going to increase the demand for space and for real estate.
Yeah, I mean, look, no one chooses inline except for cost. It's not better from visibility perspective. It's not better for convenience. There's no better reason for the tenant. It's always about cost, meaning, can I justify the cost of being freestanding or not? That's always been the issue, right? As construction costs go up, you have to do a certain volume of business in order for that to work. But, from a visibility, from a branding perspective, from a convenience, and from a drive-through, everybody wants to be freestanding. It's just a question of, are you big enough to do it? So like, you see a lot of firms like, Subway and Jimmy John's and things who are not, large enough in volume to move out for the most part. But you see a lot of tenants that used to be, strip center based, which is Dunkin' Donuts and Panera, who decided, look, I need my own facility, and I'm willing to pay extra for it.
Yeah, that's true. Okay, so I mean, who is your niche? Who's your avatar? Who's somebody that, like, the ideal person that you like to work with?
Our demographic skews older. It skews, veteran real estate people who've been in it for 20 or 30 years, have bought properties with a low basis, and, they go to sell it over time, and they have a substantial gain locked in. And, they look at the tax rates, especially the tax rates, which are coming up recently, and they say, this is the gigantic tax bill. I would rather buy, a restaurant or medical facility or what have you with a long-term lease, not pay the taxes, and collect this income stream as I retire. That's really our bread and butter target market.
Okay. And so for anybody looking to reach out or get in touch, what's the best way to do that?
Either go to the bouldergroup.com website, our contact information is there, or look me up on LinkedIn.
Okay. Yeah, great. Well, yeah, Randy, this has been awesome. Talking economy, future predictions, finance, all that good stuff. Yeah, definitely appreciate it. And, we'll look forward to staying in touch and connecting in the future.
Thanks for having me. Keep up the podcast. I'm a listener, not just a guest host occasionally. So it's been great, and great getting to know you better. And I appreciate it. Didn't realize I was getting into an inflation discussion today, but happy to do so.
Yeah, sorry to throw a curveball at you there.
No, that's part of the business. It's a major factor impacting everything we do.
Yep. All right, Randy. Well, yeah. We'll keep in touch. We'll talk soon.
Thanks again, Austin.